thank you so much for getting up early and coming this morning. We're delighted with the program that we're going to have. We're excited. This is, as a lot of you know, that we're now passing our 25th anniversary at Chapman Hext. And so it's been an interesting, but seems like a very short trip sometimes. And but we're delighted. We could not have done it without all the folks in this room and throughout the Dallas-Fort Worth Metroplex that we get to do business with every day and across the United States. Some of the things you have today is some handouts from Westwood, who is actually our speaker this morning from there. Also, there's a copy of a Barron's May 2015 article with an interview from your speaker, Mark Freeman, that you have in there. We also have a CPE evaluation form, so if you'd like credit, if you'll fill that form out, turn it in on your way out. We'll make sure that those of you who are CPAs and stuff, that you can get credit for the CPE this morning. There's also a speaker evaluation form in there, if you'll fill that out for us, as well as if there are other topics you can think of that you'd like to hear about. We do purposely try and keep a lot of these different programs and stuff away from tax, accounting, things like that, and bring in other topics that we feel like the C-level execs and folks that we deal with would like to hear about. Well, as I mentioned, we're delighted to have the folks from Westwood here this morning. Westwood Holdings Group provides investment management services to institutional investors, private wealth clients, and financial intermediaries. They have more than $20 billion in assets under management, and the firm manages a range of strategies, including U.S. equities, master limited partnerships, multi-asset, global and emerging market equities, and global convertible securities portfolios. Access to these strategies is available through separate accounts and through the Westwood funds, their family and mutual funds, and other pooled investment vehicles. They benefit from a significant broad-based employee ownership, but they also trade on the New York Stock Exchange under the symbol WHG. They're based in Dallas, but Westwood also has offices in Toronto, Boston, Omaha, and Houston. I wanted to have the privilege this morning of just telling you a little bit about them. I'm going to turn it over to Michael Meadows, who's with Westwood Trust, and let him introduce Mark and talk a little bit more about their firm, and we'll jump into the program. And we'll let Mark be the guru that he is this morning and tell you how the world's going to work over the next 12 months. Now set you up. So there you go.
I've had the privilege of being a friend of Greg Hex and his wife Kim for probably about a decade now. So Greg, thank you very much for having us here, and Simon, good to see you. Welcome everyone this morning. Delighted to be here and to have an opportunity to talk to you a little bit about what's coming up in the markets in the coming year. We're going to hear from Mark Freeman, our Chief Investment Officer. Mark actually joined Westwood back in 1999. At this point, he's risen to the point of where being the Executive Vice President and the Chief Investment Officer for Westwood Holdings Group. As Greg kind of alluded to, we have a number of different lines of business, which include the institutional side, we have the mutual funds, and then we have the trust side. So if you're ever looking for a corporate trustee, please let us know. And if there's any of those other that are of interest, you can always let me know, and I'm happy to direct you to the right people. But talking about Mark just a minute, Mark is also one of our senior portfolio managers, and he is responsible for developing the firm's economic outlook, which you're going to hear today. Additionally, he is a member of the firm's Asset Allocation and Business Management Committee. He graduated from Millsaps College with a BA in economics, and then got his MS in economics at Louisiana State University. One of the things I really like in Mark's past is that it's very different from the investment world, is that he actually started in the Peace Corps in Africa. And from there, he ended up working for KPMG and First American Corp as a senior economist and fixed income strategist. He has achieved the designation of Chartered Financial Analyst back in 1998, so it was a long time ago. He is a member of the American Economic Association and CFA Institute and the CFA Society of Dallas-Fort Worth. He is also a member of the Board of Trustees at Millsaps College and the Wilson Fund, and very active in Capital for Kids. And I'm sure he'd be happy to talk to you about that one. An organization of investment management professionals who help raise money in order to meet the needs of at-risk kids in this area. So without further ado, I'm very pleased to introduce Mark Freeman.
Okay, great. Thanks, Michael.
Thank you.
That's for you, because I haven't done anything yet. So from there. Look, hey, good morning, everyone. How are you? Good. All right, fantastic. Before I kind of jump into this, Michael's heard this before from me, but whenever I come and talk to a group like this, it reminds me a couple of years ago. I've got two boys, and now they're 11 and 14, but this was 3 years ago, and so it was my son. He was in 4th grade, and it was career week, and my wife says, "You got to go." And I was like, "No." She's like, "No, you got to go. You're going to go talk to the class and tell them what you do." And so I was really nervous about it. And so I go to it, and I'm talking to them, and they're, the kids are all kind of gathered around, and there was a boy in the back, and he's like actually gets excited, and he's actually listening to it, and he says something to the boy next to him, and he kind of gets excited. And I'm going along, and a couple of the others, and I'm like, okay, this is okay. This is good. They actually think what I do is cool, and they're going to like it, and my son's going to be okay. So I go through it, and then so I end it, and I said, well, look, does anybody have a question? And that boy in the back, his hand just shoots straight up. And before I can even ask him, say what it is, he just yells out, he goes, "You look like Harry Potter." And that was it. So look, I don't know if I have any clout with you, but I've got some serious clout with 4th graders, okay, in that regard. So, okay, well, look, let's kind of jump into this. I know it's early in the morning, so I'm not going to kind of just overwhelm you with economic stats and all of that. What I want to do is I just kind of want to touch on what I think are some of the more pertinent issues right now for the economy and really more specifically for the markets, and then get to what is actually most beneficial to me, which are your questions and your comments. I love doing these things, these type of events, because it allows me to interact with you and learn from you, as opposed to going back to my office and looking at screens and numbers and things of that nature. That's helpful, but it's helpful to talk also to individuals like yourself. Let me just kind of tell you what this page is. As Michael mentioned, we do an economic outlook, and we do it typically in August or September of each year. And basically what we want to do is think about what the year ahead is going to look like, okay? And really, it's not so much about getting a forecast, an economic forecast, but it's really about, we want to think about what is the operative, which is what we think is probably the most likely scenario. And then we think about other scenarios, scenario 2, scenario 3 there. And we kind of view those as kind of outliers, possible events, but probably not the most likely. But what it helps us do, bless you, well, what it helps us do and how we use this is we're really just trying to create a risk matrix. We use this purely to basically evaluate the risk profile of the markets, okay? And that's kind of a critical part of what we do at Westwood, is evaluating risk, okay, from there. So again, that's how we look at this, and that's how we think about it. The other thing is about each one of those scenarios, from there, we give them a specific title, okay, from that, because we want to actually kind of convey a message. And I'm going to get to that in just a second. But let me kind of just cut to the chase. On the economy, I get asked all the time, hey, what's the U.S. economy going to do, okay? And my response is being I guess has been my training as an economist, is to respond back with a question, okay? And the question though is look, well, what's wage growth going to do? Okay, and so ultimately, if you're looking for a single kind of variable that's going to tell you what the U.S. economy is going to do, that's it. Okay, it's wage growth. Okay, and that's ultimately is where we have kind of been tracking along. Wage growth is running around 2%, maybe a little bit higher, slight uptrend there from that, and that's ultimately is kind of where growth is. All right, so kind of we're using 2.7%. Look, is it 2.5? Is it 2? It's somewhere we think in that ballpark. Okay, from there, and that's kind of important in terms of what is that growth rate, and here's why. And this is why, in terms of our operative, you see that title there, and it's called Driving in a School Zone. Okay, and so many of you actually even this morning, okay, coming here. But think about this, and the analogy is, you're driving along, let's say the speed limit's 40 miles an hour, and then what happens? You come up to a school zone, there's the flashing sign, it says school zone, speed limit's 20, okay? And then you're in that school zone for a period of time, and then eventually though you come to another sign that says school zone ends, speed resume is 40, okay? Well, what that is meant to kind of, the analogy there is that a decade ago, the potential growth rate, real growth rate of the U.S. economy was roughly about 4%, okay? And again, it's real simple. Well, how do you know what the potential growth rate is of any economy? It's two variables, growth rate of your labor force and your growth rate of productivity, okay? That tells you what your potential growth rate is, okay? So a decade ago, before the financial crisis, it was about 4%, real growth. Today, okay, and so think about that 4% is about 40 miles an hour, okay? Today, let's call it 2%. The Federal Reserve actually believes it's less than that, about 1.5%, okay, from there. So that's kind of your 20. So the question is at what point do we get to go back to driving 40? Or do we? Okay, that is now the debate in economic circles and for the markets, and not just in the U.S., but on a global basis, is when, on a global growth basis, domestic growth basis, when do we get out of the school zone? Okay? And how that plays out is critical, okay? And now look, this matters ultimately, okay, and it's, we can talk about it from an economy standpoint and all of that, but ultimately, why that matters, why that potential growth rate matters, is because it's probably the single most determinant variable on ultimately determining the rate of return on assets. And that's probably why a lot of you in this room is ultimately, yeah, we can talk about the economy, but what we really are focused on and what we're really looking at is the rate of return on assets, okay? And even if you want to take it a step further and you say, well, look, okay, give me like a tangible example of that, is that rate of growth, think about it, is also the single most important variable in terms of determining aggregate corporate profit growth. And I'll show you a chart in a minute. And so just like I said, wage growth, okay, if you want to know, tell me what the economy is going to do, tell me what wage growth is going to do. Okay, if you want to know what's the market going to do, tell me what corporate profit growth is going to do. Okay, and I'll show you a chart on that in a moment. So that's why we care so much about it. That is why in this current environment, that matters. Now, the other thing, Janet Yellen is speaking this morning, giving her semi-annual testimony to Congress from there. But if you remember back in December, what did the Fed do? Raise rates, right? Okay. A decade ago, if I were to tell you we've got sub 2% growth, you got inflation maybe at 1%, depending on measure what you want to use, the Fed wouldn't be raising rates. They would be cutting rates, okay? And the reason why they're raising rates is, remember I told you that the Fed thinks our potential growth rate is roughly 1.5% from there. From their standpoint, they think we're speeding in the school zone. Even though we're only growing about 2.5%, we're growing above our potential growth rate, okay? And you may say, well, why do they think that and why does that matter? Okay, it's because, well, what they look at, or you may even say, hey, look, I don't even buy that. I think our potential growth rate is much higher than that. Productivity's got to be higher than, right now it's running about 0, okay? Maybe 1% over the last 5 years, okay? From there. But that's why they're using that and they're saying, well, look, the reason why we know we're operating above our growth rate is because we can look at what we call resource utilization rates. That's just a fancy word for basically how much capacity do you have. And the resource utilization rate that they look at the most is the unemployment rate. That tells you how much resources you have in the labor market. And we're now down to 4.9%, okay? And so over the last roughly 4 or 5 years, we've had about 2% growth, and the unemployment rate's gone from 10% to 4.9%. So even though we're only growing at about 2%, we're having to add about 200,000 jobs a month to grow at that level. That tells them that, okay, our potential growth rate is fairly low right now. And so that's, whether it's right or wrong, that is their mindset, okay? So that is why, again, with 2% growth and 1% inflation, they felt the need, hey, we need to start on a tightening cycle, okay, from there. Now, their expectations are going to change, and matter of fact, our testimony today is going to change that also from there. Last thing I'll just kind of mention on this, the other thing we use, we'll talk a lot about that number there, that S&P 500 operating profit number, because that matters, okay? And so today, before we came in, at the top there you see S&P 500. It was 1940 when we did that in January, on the end of January. Today we're at 1850. Okay, so we've had a little pullback, as they say, in our business from there. But if you take that 1940 roughly $19, 17.5 multiple plus your dividend. That's 2,100 on the S&P 500, roughly. Okay, so that's the way we look at this, and ultimately it's about. And then we have a bond outlook, and then we say, okay, well look, given current levels, are things over or undervalued? This would tell us again with bond yields where they are. We feel like bonds are fairly a little bit slightly overvalued, not a great return profile. Equities, provided the corporate profit growth comes through, actually now, or even more so now, they're about 13% undervalued. Okay, from there. So this is kind of how we look at it, and then we look at it under various risk scenarios. So let me kind of move forward. This is where we kind of get into kind of more of the specifics here, okay? And again, I know it's early in the morning, and again, I don't want to put you back to sleep with this, but this matters, okay? This part here. And what this slide is, you see it's the S&P 500 operating earnings per share. Okay, so think about the S&P 500 basically as a company, single company, okay? And you aggregate the earnings of all the 500 companies up to it, and you get an earnings per share for the market, okay? And ultimately, so this is tracking it. This is quarterly data, but ultimately, I could overlay the S&P 500, the market on there, and it's going to look basically just like this, okay? The market is going to follow this line, and this is corporate profit growth. So the interesting part of it is where we are now at the very end. There's basically two major companies that track this data. One is actually S&P. That's the blue line. The red is Thomson Reuters, sometimes known as First Call. Okay, you'll hear these names and kind of sometimes in the press from there. But what you see is that they follow each other very closely, except for kind of where we are now. Thomson Reuters is basically saying corporate profit growth has flattened. It'll actually for this year will be basically about down 1%. S&P is showing a much more significant decline. Okay, from there. They're actually, in their current estimates, we're going through fourth quarter earnings now. They're looking at about an 8% decline year over year in earnings, okay? And just real quick, if you're wondering, okay, well, what's the difference between the two? S&P basically tracks GAAP earnings, okay? So when companies report and they may have certain charges or kind of extraordinary items or one-off items and from there, S&P includes most of those on an operating basis. Thomson Reuters basically says, look, we're going to look through those, and they exclude it, okay? And so the big difference there, this probably won't come to a huge shock to you, but that where most of those items and charges coming from is in the energy sector, okay? So S&P is basically saying, look, we're including those, Thomson's not. So look, you can kind of take your pick, okay? But I don't think, it's not happen chance that the S&P last year was basically flat, okay? And that red line for Thomson Reuters is basically flat, okay, from there. But really what matters, though, is what do those lines do going forward, okay? Expectations are that the lines resume an uptrend. Matter of fact, our number is 119, so it's about roughly about a 5% earnings growth rate for this year. S&P is currently at 121, so they're looking for a pretty significant rebound from there. The problem is a month ago that number was 124. A year ago it was 135. Okay, so those expectations have come down. But in either case, the course or the trajectory of those lines going forward is ultimately going to determine the trajectory of the market. Okay, if they go up, we should see the market follow it. If they go down, the market's going to follow it. Okay, from that standpoint. So let's talk about what are some of the things that are driving that. Okay, why are we now at basically flat earnings on the U.S.? Okay, there's two primary earnings headwinds, if you will, right now. One, everybody in the room, I'm sure you've noticed, certainly if you've been to the gas station lately. But one is the fall in commodity prices, and specifically oil. Okay, and that matters it matters from an earnings standpoint. Okay, and to put it in perspective, a year and a half ago, when we were still at roughly $100 oil, if you looked at world global oil producers, okay, the companies, they were at an annualized revenue rate of 3.8 trillion. Today, it's 1.4. Okay, that's a big drop. Okay, and so that from an earnings standpoint. Okay, from there. So how does this get resolved, if you will? And at what point do commodity prices stabilize. As like I said, it came into this morning, crude oil, WTI, Brent, whichever one you want to use, we're roughly at about $30, okay, on that. So I would say the price of anything really is determined at the margin, okay, by the marginal producer and by the marginal supplier. So let's look at the production side. The blue line here is U.S. Total production. We peaked last June at roughly 9.6 million barrels of crude oil a day, okay? And from there, we have another data point that shows 9.3. Today, we're roughly at 9 million. So production is coming down slowly. That red line is the U.S. oil rig count from Baker Hughes. Okay, so we have gone from, what is that, roughly 1,600 rigs to that shows you to just under 500. On Friday, we had a decline. We're now down to, I think, roughly 461 oil rigs producing, okay, in the U.S. So the question is what does that blue line do? And how does that go forward? Because look, what I meant, the reason why we're at 30 is because we have a supply-demand imbalance in crude oil. Right now, we are currently producing about 1.5 million barrels on a global basis, 1.5 million barrels a day more than we need, okay? And so that imbalance is what is causing a very, very sharp drop in the commodity price, or in this case, the price of crude oil. So how that blue line comes down, to what extent, and then projections, if what our estimates is that we'll go below 450 rigs over time over the next 6 to 12 months, that should take U.S. production down to about 8.5 million barrels a day, okay? So that's a million coming out of that 1.5 oversupply. Now, the other part of that, okay, well now let's talk about demand, okay? And again, demand, so where's marginal demand coming from? I'm using here, the blue line is China, real GDP, their growth, and then obviously the red line is the price of crude oil. And as you can see, those two go hand in hand. And so when we talk about, okay, well, what is growth in China doing from there? If you look at it over the first, in the 2000s, okay, and people refer to the great commodity super cycle. Remember, all commodity prices, whether it's copper, steel, crude oil, all were going straight up. Okay, we'll look at China's growth rate. Okay, it peaked out 2007 at roughly almost 15% real GDP. Okay, now where has it done since? Last reading, now they're at 6.9%. Okay, that's the official number. The real number is probably somewhere south of that. Okay, so but in either case, we need to see this part of it, and China's kind of a proxy really for all developing markets because they are the ones who are the incremental new demand. It's not in the U.S. and Europe. We're not the ones who are now going to. We may drive a little bit more, but look, our economies, we're actually shifting much more over to natural gas and other fuel types as opposed to using more crude oil. Okay, from there. So how that growth rate there plays out matters. Now, just to kind of get off to an aside here. China is, global demand right now, the estimate is that it'll basically increase about 500,000 barrels a day, okay, per day. That'll be the growth rate. That should get you back into basically equilibrium, okay? And that is expected again by about the end of the year. Okay, here's where things get complicated, okay, to the extent if you're interested in this. Okay, we have a kind of a, grudge match going on, basically specifically with OPEC, but Saudi Arabia. Okay, you remember I talked about U.S. We hit 9.6 million barrels per day. It was at that level that U.S. production was going to surpass Saudi Arabia. Okay, and remember, the prices are determined at the margin. The U.S. was at that point was going to become the marginal producer, okay, of crude oil, and especially if you include Canada, we were over 13 million barrels a day. Okay, so that was going to matter. Saudis did not want to give that position up, okay? And they also could see where it was going. Okay, so they have said, look, instead of them, typically, historically, they would say we get oversupplied, the Saudis would cut back production, the market gets imbalanced. They said no more. We're not playing that game anymore, okay? We're not giving up market share. You want to get back in balance, you cut, okay? Or we're going to take it out of these high-cost producing areas, U.S. shale, Canadian oil sands, et cetera. Okay, so anyhow, so here we are today. We're still looking at this oversupply, and what was interesting was last week, Saudi Arabia came out and said, any increase in global demand that shows up, we are going to meet with an increase in production. okay? And that matters to the markets because what they are saying is that either you're going to have to continue to cut more on the production side or we're going to maintain this oversupply position, i.e. we're going to keep prices low for longer. And that's what you're seeing in the market and in certain areas, certainly the energy areas, which have been extremely hard hit, is because that rationale, that realization is setting in, okay? The markets and analysts were very, very slow. They're like, yeah, we're at 40. Okay, we're at 40, but we're going back to 60, okay? And now they're saying, well, we're at 30. We may go to 20, and we may stay in this area for longer than we expect. And that matters, again, from an earnings standpoint, okay? So this is why, but in either case, from an aggregate earnings standpoint, we need to see how that commodity price plays out matters from there. Okay, now let's talk about something else a little bit differently. Here, but it matters because ultimately, I remember I said it's commodity prices and the dollar. Okay, if you can kind of walk through this, I know it's a little difficult to see, but that red line coming across, these are what these are. If various central banks around the world, their deposit rates. Okay, so it's kind of like when you and I, if we go to a bank and then we have a savings account or checking account and they pay us rate on our deposits, these are the rates that these central banks pay other banks who keep reserves at the bank, at their bank, okay? So the Fed, that red line, flat, basically it was at 25 basis points, and then in December they raised the Fed funds rate and the deposit rate's at 50 basis points now, okay? But if you look at the other lines, let's look at the kind of bluish line, that's the European Central Bank, okay? And now that, notice, okay, so they've cut several times and now they're at negative 30 basis points. So if you're a European bank and you're keeping deposits at the European ECB, okay, you're not getting paid, you are paying them 30 basis points to keep your money there, okay? Now they're using that as an incentive, if you will, to say, hey, how about don't keep your money here, why don't you go out and make loans with that money, okay? Problem is, A, there's two things. One, there's got to be demand for loans, or two, the banks have to be in a position from a capital standpoint to be able to say, yeah, we can go out and make new loans. And in Europe, you got a little bit of both. But in either case, that's trended down. They're at 30 basis points. The next line is Sweden. So Sweden Central Bank, they're at negative 35. The Swiss Central Bank is at negative 75 basis points. Okay? So a couple weeks ago, what did the Bank of Japan do? They're now negative 10. So now you've got the Bank of Japan, you have the ECB, there's a couple of other we can put in there, but they all have negative interest rates, okay, that they're paying from there. Now, we can talk about, okay, later if you want to, but okay, well, what are the implications of that? Okay, because that's, you know, if you asked economists a decade ago, they would tell you that these negative interest rates are theoretically impossible, okay? Not possible to do this. And now what we see is that in actuality, in reality, it is possible, okay? And they can persist and they can stay at these levels. Okay, but so the implication is, though, for this slide, is that you have the Fed diverging, okay, from all these other areas. Fed raising rates. These other ones are having not just cutting rates, but negative rates. So what would be the incentive there, okay? And what is the equalization, what is the clearing mechanism? It's this. It's the US dollar. It's the currency rate, okay? If you're going to have to pay to keep money in Europe, well, the other thing, instead of making loans, you may say, hey, you know what, instead of that, how about if I take my euros, or if I take my yen, or I take any of these other currencies and say, you know what, why don't I go over here where they actually have higher rates? And so you do that, the US dollar, the value of the dollar goes up. And that is what we saw driving this rather significant move up in the market. I mean, the value of the dollar, okay? And so depending on how you want to measure, you may say, well, look, well, why does that matter? Okay, from there. Well, think about this. Again, always relating it back to earnings, okay? Is that depending on how you want to measure it, you've got roughly, you know, the S&P 500, approximately 40% of revenues come from outside the U.S. And as that dollar appreciates, then the dollar value of those earnings are actually going down. So this dollar, whether or not it keeps going up, now we've seen it kind of been relatively stable here of late from that, but if that continues to move up, then that remains a headwind for earnings, okay? And those are the two biggest variables, okay? Again, commodity prices, crude oil, and the dollar, okay? And in terms of earnings expectations. So just kind of that's what we're watching and following very, very closely. The last thing here, and Janet Yellen, actually, I saw before I came in, they had released her text beforehand of her speech. And basically what she's saying, and the market already knew this, because the Fed in December said, yeah, we raised today, and basically we expect to raise rates 4 more times in 2016, okay? And the market was like, good luck with that, okay? The market was like not happening. Matter of fact, coming in here today, market expectations are that the Fed will not raise rates again this year, okay? It has a less than a 50% chance by December of another rate increase. Okay, and the reason why is because of this. It's called a financial conditions index. Okay, and what it does, it goes out and it looks at things like the dollar. Dollar is one of the variables. It looks at bond yields, but the most important thing that it includes in here is what we refer to as credit spreads, which are basically risk premiums. Okay, and of late, what you have seen is that specifically risk premiums and credit spreads, as investors have become much, much more risk averse, you're seeing those credit spreads move up sharply. Okay, in the high yield market or in the debt market, companies want to go, the spread they have to pay over the risk-free rate has gone up. Okay, and what that represents, and when that line moves up, it means that financial conditions are getting tighter. Okay, and so the Fed is obviously aware of this. And so the title of this slide, if it was on here, it says the Fed's not the only one tightening. And this is what Janet Yellen noted explicitly in her testimony this morning. She said that financial conditions have gotten tighter. Okay? This is doing the Fed's job for them. And not that they want it to, but it is. Okay? Matter of fact, that last little run up there is worth about 50 basis points of tightening from the Fed. Okay? So this is one of the things that we have to be aware of because, again, there's other ways for financial conditions to become tighter as opposed to just the Fed raising rates. Okay. So in either case, I just kind of wanted to give you, kind of a survey of the landscape, but ultimately it comes back again to the fundamentals, which are earnings and valuations. Okay. So look, I know I kind of threw a lot of different things at you, but I'm really trying to keep it, again, back to what we feel matters the most, and again, that's the fundamentals. Okay.